Hi, guys. Tim Melvin here on what is shaping up to be a beautiful Saturday down here in Southwest Florida. Probably have some poolside time in my very near future. Anyway, guys, it's been a week, hasn't it? The Fed raised rates as I expected by 50 basis points on Wednesday, and the market loved it. Never mind all the remarks that Jerome Powell made about fighting inflation and the slowdown in the economy and everything else he had to say. There was a thought that they were going to raise 75 basis points, even though Powell had said that wasn't on the table. So, in a relief rally that we did not, in fact, see a hike of 75 basis points, market shot up over 800 points Wednesday afternoon. Everybody loved the fact that the Fed had raised rates. Then they went home and they had some time to think about it. Maybe they even read some of Powell's prepared remarks and comments at the press conference, where he made it clear that the Fed was not in a great place. The economy is slowing down. We've seen it in several key measures. Negative first quarter GDP. Inflation's not going away, still running at 40-year highs. And the Fed has made it clear they're going to raise rates throughout 2022. We've probably got another, at least one 50 basis point hike and several 25 basis point hikes still to come in 2022. And this could continue well into 2023 until they can get inflation from its current 8% and higher mark back under 2%. This is going to take a while. Rates are already moving up, 10 years at 3%, going to go higher. We haven't had the 10-year at 3% since 2018. We haven't had this kind of inflation and rate increases in a very long time. We haven't had a tightening cycle now since the great financial crisis. Before the great financial crisis, back into the earlier part of the new century, around 2003, 2005, we had a small tightening cycle. So most people on Wall Street haven't seen this before. They're not quite sure how to react. Once all this digested Wednesday night, we gave all the gains back on Thursday and had continued weakness on Friday as reality began to set in. Inflation is very high. Interest rates are going higher. The rally's been built almost entirely on low interest rates. Rising rates are going to just poke a big hole in the bubble that has been stock prices. Now, if you've been following along, guys, since I started doing videos again a couple months ago, and even going back into the videos we shot during the great disastrous and failed traders agency experiment, I've been telling you this was going to happen. And I've been telling you that not because I'm just such a super genius that I can time markets. I'm on record. I'm a terrible market timer. However, I can read what interest rates, what the yield curve and what credit spreads are telling me. And they've been telling me for a while, this is not a great time to be buying indexes. And you really need to get away from the high multiple, unprofitable story stocks that a bad ending was coming, and indeed has finally come for those stocks and for the indexes. They're still not screaming that it's a great time to be a buyer of the indexes or the high multiple growth stocks, by the way. This is probably just getting started. We've got some more pain ahead in the indexes. And I just don't think being a normal, run of the mill, going to buy the growth stocks, going to buy the indexes investor is going to work for the next, I'm going to say 5 years or longer. With very low interest rates as a starting point, very high valuations. So that's going to be a lot to overcome. And you're really going to have to be following me into some of the nooks and crannies and, back rooms of the markets in order to make monies for the next several years. Fortunately, I've got a great track record for doing exactly that. Now, speaking of track records, guys, I was having a conversation the other night with someone that I respect a lot. He's one of the best content guys in the business, has been instrumental in building several of major, franchises in financial publishing. When he talks, I tend to listen. And I remarked that, look, this isn't the first time that I've gotten this right. And again, it's not because I'm a super genius, right? I'm never going to time this thing exactly right. I'm always going to be early. But I can kind of identify when markets are too cheap and when they're too expensive, and either urge aggression when it's too cheap or caution when it's too expensive. And we've been sounding out on caution for a while. We sounded out on caution big back in 1998 and 1999. We were doing primarily just real estate investment trusts, small banks, and liquidation arbitrage situations back then. We were not involved in the technology stocks. If I had clients that really pushed the point to buy technology stocks, I sent them down the street to Merrill Lynch because I wanted absolutely nothing to do with that. There was only one way that could end, and it was badly. I was early. I probably missed some gains, but I missed all of the losses. And I would rather do that than participate in what is clearly an overvalued, ridiculous market. Now, in 2002, 2003, we had a lot of technology companies trading for less than the cash that they had in the bank. We had convertible bonds issued by technology and telecom companies, that were performing, trading at 50 cents on the dollar, still making interest payments, still had cash in the bank to make the interest payments. So we bought a whole bunch of those, and clients ended up doing extremely well. By 2007, we couldn't find anything to buy. Banks had gone through an aggressive M&A cycle. They were all trading at 1.6, 1.7, and even 2 times book. Deals were getting done at 3 times book. It was insane. We paid the bills my last year in the brokerage business primarily through SPAC, special purpose acquisition companies, which were red hot at the time. Arbitrage trades with hedge funds and arbitrage shops. That's how I kept the bills paid until I left to go to a Wright for real money in early 2008. And that's a whole nother chapter, a whole nother story. We'll get into it another day. Coming into 2019, we had been warning sometime every week when we went on, and we shot the videos for the Heat Seeker service. We said, look, the broader market is ridiculously overvalued. Forward returns are probably going to be very low. You got to specialize. You got to work harder. You got to look for special situations. And you know what? I didn't know COVID was coming. I just knew the market was too expensive. We were proven right. Initially, during COVID, our stock and phrase was do nothing, right? We don't know how this is going to end. It's serious, do nothing. Once stimulus programs began to be passed, and it became obvious that the problems and concerns that we thought might impact the banking industry did not come to be because of stimulus programs and PPP loans and other measures that Congress and the Fed took. Then we started urging people to get back into the market. We were telling people to sell puts on high yielding stocks, to harvest premium, and to get back into the blue chips, into Brookfield Asset Management, into Berkshire Hathaway, into some of the bigger growth compounding machines. We really got aggressive about trying to get people back into all those. That worked out very well for those that took our advice. We've been saying for some time now that this market is overheated. And again, looking at interest rates, looking at valuations, going out, it was going to be tough to make money for the next several years. And, so far, we're being proven to be right again this time. My friend pointed out to me, it didn't matter how good the track record was. It wasn't enough just to be right. You had to get the marketing message right. And then, in fact, some of the better sellers in the financial publishing industry actually have crappy, that's a technical term, track record. So that bothers me no end. It's, as an ex-door-to-door salesman, if I can get in front of you and talk to you and, tell you about the compelling opportunities in small bank stocks, in private equity replication strategies, in closed-end fund discount arbitrage strategies, I could probably get you to sign up and come on this journey with me. But this big, broad marketing package where I appeal to millions of people, I'm terrible at it. Again, the technical term there is I suck at it. Can't seem to do it. We've built one hell of a track record. I think it's the best in the industry at banking on profits, and at the other services that I've offered over the years. We've done a fantastic job. So if you're satisfied, if you're a subscriber, please tell somebody else about it. If you're not a subscriber, go to marketfi.com, sign up for Banking on Profits, and give us a chance to make you some money and avoid the dangerous spots of the market. It's not that I'm a great market timer, but I am pretty good at this corporate valuation stuff. And I can tell you that sometimes the market is just flat out overvalued. Credit spreads and the yield curve tell a story. They're usually right, and I'm pretty good at reading and interpreting that story. So anyway, that's just an observation that it's a little disturbing. Wall Street, of course, has known this forever. It's more about the story than the facts. I like to live in the facts. I do this to help you make money and make a living at the same time. I don't want to be the top seller. I want to be the top performer. We've been doing that. And hopefully at some point some of you folks come in and give us a chance to make you money the way I have been for subscribers since 2013. Now, looking at the broader market, guys, it's still not cheap, right? The S&P 500 is still trading at about 24 times earnings. The CAPE ratio is 32. That's way above the 10-year average, which is around 25. The market cap to GDP, Buffett's preferred indicator, is still at 168%. It's down from the 200% that it was at, but it's still pretty elevated. It's even way above 2007 levels, right before the great financial crisis, which was the highest I'd ever seen in my lifetime. We're way above that level now. So still very inflated. You just had a negative quarter of GDP growth. That's not getting any better anytime soon. Stimulus is coming out of the market now. Consumers we're still spending money, kind of catching up with stuff from the pandemic, but you can see the consumer kind of sentiment is turning. People are getting nervous. They're a little more interested in saving up their cash than they used to be. So I don't think the market is tremendously cheap. I am seeing some opportunities in special situations. I'm seeing some smaller banks because bank stocks, on fears of a slower GDP and a recession in 2023, have gotten pretty well beat up in the last month. I'm seeing some of the banks that I've had my eye on now get down into the have to buy zone. Not the, I'm okay buying them here, but you got to buy them. They're too cheap. They have too much capital. The loan portfolios are pristine. Non-performing assets, delinquencies are very low. And the price to book value is getting down to the point where it's going to be really hard to not make money in these stocks over the next couple of years. So we're going to start adding these. Got like 7 names right off the top of my list that I think if the weakness continues into the first half of next week, they're going to go into the Banking on Profits portfolio. So you need to get over there, by the way, and get signed up so you get these stocks as I release them to subscribers. We're also seeing a lot of opportunities in the corners, special situations, and I think energy stocks are ridiculously cheap. So this week, I'm not going to give you a high yield bank stock. I'm going to give you a small cap energy stock that I think is trading at a fraction, maybe a third of where it should be trading. It could be even more upside than that. I could see an easy 5x over the next 2 to 3 years, and that's in spite of the fact that the stock's already up quite a bit. Amplify Energy, that's AMPY. Stock sold off. They had an energy spill in waters off of California last year. Natural energy spill and energy company, that's a toxic combination, right? We saw a lot of selling in the stock. It got pretty well hammered. Now, this company, they're not just in California. They do business in California, obviously, but they're also in Oklahoma, the Rocky Mountains, East Texas, and North Louisiana, and in the Eagle Ford Basin in Central Texas. Now, the oil field, the regulators are not blaming Amplify. They're pointing at possibly the shipping company that was involved as having more than their share of liability here. And the insurance company, of course, is also having to step up and make some payments on this. So all of this is not falling on Amplify's shoulders. And in fact, I don't think they're going to pay too high a price tag for this. They're going to come out of this just fine because it doesn't look like this spill was their fault. The shipping company is more to blame, I think, and will shoulder more of the cost of this thing. Anyway, guys, no matter what happens with that, no matter how much they pay out, the stock is trading at about 3 times the cash flow that they're going to produce this year. And that's with 25% of their reserves blocked off because of the oil spill and the fact that one of their pipelines is shut down. They're in the process of restarting that pipeline and getting the regulatory permissions. Should happen later this year. Even if it doesn't, 3 times the cash flow they're going to produce. Last year, using the PV10, present value of the 10-year supply of the reserves that this company has of oil and gas, the value at $65 a barrel oil was $18 a share. The stock's at $7.50. Oil's now comfortably over $100 a share. I don't think we're going back to 65 anytime soon. We've created through 20, 30 years of really bad energy policy and not building a transition or a bridge to a renewable future using oil and gas. We've shut off too much supply. The supply-demand imbalance globally is way out of whack. Take Russia and Ukrainian oil out of the equation as we have, and it's even worse. Without a big shift in our energy policy, the supply-demand imbalance will be permanent. Hopefully we make some adjustments. I don't have a lot of faith in politicians, as you know. We'll see. Oil and gas prices are going to remain elevated. Demand is growing, not slowing, and that's going to be true for a very long time. Yes, renewables is going to happen. Yes, I'm excited to see it happen. No, it's not going to happen on the timeline that the politicians and activists have told you that it will. We're going to have a supply-demand problem unless we start pumping more oil. At the $100 barrel level, this stock is worth well into the mid 20s, maybe even the low 30s from the current price of $7.50. I'll be really surprised if we don't see activists and maybe even private equity firms starting to sniff around this stock a little bit because it's just simply too cheap. They get the California production back online, the pipeline restarted, and now this thing might be trading for 1x free cash flow. Way too cheap, out of favor, ridiculously priced, a lot of upside. Quite frankly, I don't see a lot of downside given the current state of the oil and gas industries. So there's my pick for you this week. Amplify Energy, AMPY. Looking at small banks, seeing some opportunities. Still not excited about the broader market and would urge you to proceed with caution and to consider just getting out of and avoiding all of the large cap growth stocks that have great stories, high price to sales multiples, and no profits. Anyway, guys, I'm headed poolside. I'm Tim Melvin. Thanks for watching. I'll talk to you guys early next week.